Hello and welcome to Money Matters. My name is Jim Butler with Marcum Wealth, and my colleague tonight is Jeff Watkinson of Watkinson Capital. Hi, Jeff.
Good evening, Jim. How are you?
Good. So we have a special guest for our show today, and before we bring him on, why don't we chat for a few minutes about relevant topics and some issues that we think most people will find of interest. And as you and I know, we don't want to date ourselves with the timing of when this show gets aired. However, we're in a market downturn, and both from an economic and market standpoint. So those conditions have been with us for a while and very likely going to continue for a while longer. So what is your reading of where interest rates are headed, say over the next 3, 6, 9 months, and how that relates to Fed activity? And, you know, are they doing a decent job? Are they playing catch up? Or what are your thoughts?
Thanks, Jim. Every month we're looking very closely at the CPI numbers and the PPI numbers. And I believe both the stock and bond market are looking very closely because we all want to know how the Federal Reserve is going to react. And we're not in the business.
CPI and PPI, could you just define those briefly?
Yeah, one is the consumer price index. It's a month-over-month indication of inflation. And the other one is the purchasing power index. I mean, that's more of on a wholesale level.
Right.
So what we're dealing with is we're trying to see the rate, the rate of change in these rates. And it's all about, the Fed. You can't fight the Fed. The Federal Reserve has said we're going to beat inflation no matter how high we raise interest rates. And we're not in the business of predicting interest rates, but we're definitely paying attention to what the Federal Reserve is doing. So every month that's something we're keeping our eye on. And the Federal Reserve has stated that we will risk a recession or pull this country into a recession to get control of inflation. That's how important and that's how corrosive inflation is. So it's something we're paying attention to every week. We've seen tremendous volatility in the 1-year, 2-year Treasury, the 10-year Treasury. And it's something we don't make predictions with regard to interest rates. We're looking at the best bonds, the best municipal bonds we can buy now, attractive, what's in the marketplace. It takes a lot of work on the front end to locate these bonds, to successfully bid on these bonds, and to find a price that is of value to our clients. We're trying to squeeze out 15 to 20% extra yield, net of our fees. So we're not in the timing the market. We cannot time the municipal bond market. I don't have a crystal ball. If you have one, please send one over to me, but I don't have one.
Right.
But yeah, it's been a challenging year, but it's a very rewarding time for new money, people who are in the marketplace with municipal bonds, because you're earning your interest every day. Bonds are being called, bonds are maturing. You have new money to put to work at higher rates. And, it's all about earning that daily interest and not timing the market. I mean, Jim, you're a certified financial planner. You're dealing with a bigger, comprehensive, you're dealing with everyone's entire assets. We're very rifle shot, stay rich portion of your portfolio. How are you? What kind of conversations are you having with your clients concerning this economic downturn and the fact that both stocks and bonds are down year to date and inflation is high? I mean, it's the perfect storm, right? So how are you handling your clients' concerns, and what kind of conversations are you having?
So we try very hard to first of all understand any current concerns that most people have, and they're understandable, but put in a longer term perspective. It I think helps to frame it from a time frame standpoint. if we look back, excuse me, over the past 50 years or so, we see that, if we are either in a recession as this show is being taped or moving into one, I think the reality is we're certainly at the doorstep of what is likely to be probably about the 9th recession over the past, again, 50 years or so. However, when you contrast that against how severe they have been, the most severe one occurred in the early pandemic time period in February to April of 2000. It lasted a short 3 months roughly, but yet the GDP went down almost 20%. So that was the most severe. But other than the pandemic itself, it feels like we bounced right back. We almost have to go back to the recession of 2008, 2009, when that one lasted about a year and a half. And up until the pandemic recession, that 5% decline in GDP was pretty darn painful. But here's what's interesting, Jeff, is since 2009, when the market troughed, the S&P 500 index has had a return through the end of 2021 of about 17.5% when you include dividends. So if you take about that 13-year time frame and say the S&P returned 17.5, but then lay that against a 30, 40, 50-year time frame for the S&P, now the return of that index is closer to 10 to 11. So long term, 10 to 11 is pretty normal. The last 12 to 13 years at 17.5 was above normal. So in a sense, we're digesting a lot of overstimulus that certainly has occurred, from 2020, 2021, and even through today. Excuse me. So today hurts because the market's down, and in a sense, it doesn't feel good. But in a longer term time frame, it really comes down to, I think, perspective and how money typically needs to stay invested over much longer time periods. It's not, certainly we all have needs for short-term money, but when you're putting together, say a laddered portfolio of municipal bonds, you've got some longer durations in there for longer-term money. So we want to balance the portfolios between having some growth on the equity side and potentially some income and tax-free income at that on the fixed income side.
Absolutely. There's a lot of volatility right now, but when you buy individual bonds, you know that bonds heal over time and your bonds will mature at par. It's like watching the movie Titanic with Leonardo DiCaprio. Like
Right.
when you buy a bond, you know the ending of the story.
Right.
And
Right.
when you, at the beginning, you know when you're going to get your money back, and you know when you're going to get your coupon payments and how much they're going to be.
Hey, Jeff, that leads into the question. Actually, that's a perfect lead-in. A gentleman by the name of Bart Winston has written in asking what happens when a municipal bond is called.
Great question, Bart. A call feature in a municipal bond or corporate bond is simply, it's in the indenture, it's in the official statement, and it tells the investor that, let's say the call date is September 1st, 2027. On that date, the authority, let's use a local example, say it's the Philadelphia Housing Authority, they reserve the right to call that bond, which means if you owned 100 bonds or $100,000, those 100 bonds will be called, they'll be taken out of your account, and most bonds are called at par. You have to read the indenture. Some bonds are different, but you will get your $100,000 back plus any accrued interest. So about a month before the bonds are called, you'll get a notice from your broker dealer. Hey, your 100 Philadelphia Housing Authorities will be called on September 1st, 2027. and now you'll get your 100 grand plus any accrued interest. And now you have to figure out what you're going to do with that money when the bonds are called.
Very good. If you have questions that you would like us to answer and address, stay tuned. And here's how you send us your questions.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Welcome back. Our guest this afternoon is Dan White of Dan White Associates. And welcome, Dan.
Thanks, Jim.
For the benefit of our listening and watching audience, can you give us just a brief snapshot of your area of expertise?
Yeah, we work primarily in the retirement planning space. So I'd say the majority of our clients are 55 and older. They're approaching retirement. And as we know, they have a lot of key decisions to make regarding Social Security, when they're going to claim it, Medicare, how they're going to draw down on their retirement assets. So there's really no playbook for any of this. And people are kind of left on their own. And that's where we can step in and help them make those key decisions.
So, Dan, what would you say are some areas of concern that you're finding with your clients, not too dissimilar to some of what Jeff and I were just touching on, but what are you finding?
Yeah, it's kind of crazy out there right now. I would say the biggest concern that our clients have in general is they're afraid they're going to run out of money in retirement. You know, if you look at retirement over the past 40 years, go back to 1980, if you would, it was pretty clear cut. I mean, people work for the same company their whole working career, 40 years. They retired, they got the gold watch, they took them out to dinner, and the pension started Monday. And at age 62, they ran down to the Social Security office and claimed their Social Security at 62 because nobody lived past 70, 75 years old. But now it's a whole different ballgame. Today, nobody has pensions. Defined benefit plans are out the window. They've all been replaced by 401k plans. So it's up to you to put the money away, you to pick the investments, and you to determine whether you have enough money. We're all living longer. We're living into our 80s and our 90s today. So you really have to be careful how and when you claim Social Security. So the biggest concern that our clients have is, hey, I'm afraid I'm going to run out of money before I run out of life.
Right.
Dan, thanks for explaining that. I'm curious your perspective. I mean, running out of money. Stocks are down this year. Bonds, my area expertise, they're under pressure as well through this rising interest rate environment. Inflation's up over 8-9% year over year. What kind of conversations are you having with your clients who are, say, a year or two out from retirement and are looking at 2023, 2024, hoping to retire and not run out of money?
Our basic philosophy is quite simple. I mean, when you think about it, nobody has pensions anymore. But what is a pension? A pension is an annuity. It's flat out. It's an annuity that pays you until you die. So our philosophy is, we ask people what they want to live on a month in retirement. How much retirement income do you want to have coming in? And whether that's $5,000, $6,000, $7,000, $8,000 a month, if we can cover that retirement income with guaranteed income sources, whether it's Social Security, whether they have a pension, whether we take some of the lump sum out of their 401k and purchase an annuity, it gives people peace of mind. That allows them to sleep at night if they know they have $8,000 a month coming in for the rest of their life, come hell or high water, pardon my language, but it gives them peace of mind knowing that they have that guaranteed source of income. Now, if they have other funds on top of that, then hey, we can put that in the market. You can kind of invest that because you're not relying on the money in the market for the income. But if you're relying on money in the market, either in the stock or the bond market, to provide you with that income. And we're in a situation like we are now where, it's kind of, there's no place to hide, then you could be in trouble as far as generating that income.
Dan, take that income stream that you're referring to and tie it back to part of the conversation Jeff and I had earlier with regards to recession and the difficulties that we're facing today. How does somebody wade through recessionary time periods with the strategy that you just outlined?
Well, if you ask our fearless leader, we're not in a recession, even though the classic definition is 2 consecutive quarters of negative GDP, which we have already had. But I guess because the midterms are coming up in a month, we're not in a recession.
Right.
But I think it goes back to the same mantra that I just mentioned. I think you have to have an income plan. That's really what it's about in retirement. I tell people all the time, in retirement, it's not as much about rate of return. Nobody cares what you're earning on your money. It's more about how much income do you have coming in on a monthly basis. So, in recessionary times, again, if you had that guaranteed income set up and maybe your portfolio is taking a hit, you're losing money in the stock market, you're losing money in the bond market, but hey, over time, things will level out and go back up. But when you're retirement age, you don't have that time. So I think it's important to start maybe 5 or 10 years earlier and start building that retirement income plan so that you can weather the storm when it hits.
So how about the family that has those income needs satisfied and the target that you mentioned before? Once they have that, locked in, so to speak, and they have additional capital or money that they want to put to work, what do you do in that area?
Yeah, I think that's a situation where you can, again, invest money into the market. We don't have any problem with that. Again, our primary concern is if, we run into people all the time. They're, hey, I'm going to retire in a year or even 6 months, and they've got their entire portfolio in the market. And one of the things that we're finding, and this is kind of, I hate to say it, but it's people have kind of been brainwashed into this through the 401k plans, is what do people always allocate their money to? They go into these target date funds,
Mm-hmm.
So if you're going to retire in 2024, I'm going to go into the target date fund 2024, and I'm going to be safe. I'm going to be protected. That's what we're told. And all the target date 2024 fund means is as you get closer to that age, they're supposed to decrease your exposure to equities and move more into bonds, which are, again, supposed to be safer. But the 60-40 portfolio this year is getting destroyed. It's the worst year in 75 years for that portfolio because as interest rates are going up, the stock market's crashing, the bond market's crashing. There's really been no place to hide. So our opinion is, again, get the income set up. You can put the money in the market. You can let it sit. You're not going to have to draw on it until you're 72, until you hit required minimum distribution age. Over time, it will recover.
Right.
Dan, I read over your bio and I read that you've been assisting and advising people approaching retirement, in retirement for over 30 years. What are the biggest mistakes that you warn investors of making? You should definitely avoid, this or that. Can you shed a little bit more light on, the biggest mistakes we wish to avoid?
Yeah, I mean, it's, you see a lot of mistakes in retirement accounts, again, because people are moving them right and left. And, and one of our favorite things is 1-800-WHO-CARES, because you're dealing with the Vanguards and the Fidelities of the world, and you don't know who you're talking to on the other end of the line. And for most people, the retirement account is the largest asset they have. It's worth more than their house. It's the elephant in the room. And to them, it's their whole world. And now they're calling somebody to get advice about it. And you don't know who you're talking to. And they make mistakes. And we know the penalties with IRA accounts. The IRS doesn't play. If you make a mistake and unfortunately it becomes a taxable event, you could be looking at some big tax penalties and taxes to the IRS. So the other thing that I think comes into play, it's all about age, because I have people in here, 70 years old, and I'm like, well, how do you feel about the market? Well, it's going down, but it always comes back. I've been through it before. Like, yeah, you were thrilled before, but you were 20 years younger. You were 50 then, you're 70 now, and they're like, long term, what is long term? So it's I was at a program years ago and the speaker said, everybody thinks they're 15 years younger than they actually are. So if you're 70 years old, you think you're 55. If you're 60 years old, you think you're 45. Well, you're not, and the big difference is, when you're in the accumulation phase, when you're working, the sequence of returns doesn't matter at all. I mean, if you get bad returns early, good returns late, or good returns early, bad returns late, doesn't matter at all. But when you're in retirement, the sequence of returns absolutely matters. If you hit the bad returns right out of the gate, you're not giving the portfolio any time to recover, and the odds are very good that you're going to run out of money.
Hey, Dan, I'm sorry, Jim.
Go ahead, Jeff.
When you say 1-800, who cares? You're specifically talking about calling a hotline, a 1-800, a large asset manager, not your same advisor.
No, you're
right?
talking mutual fund companies, something along those lines. Yeah.
And these sequence of returns, if I remember talking about that and learning about that years ago. Can you get a little more specific on that risk for someone who just retired?
Yeah, absolutely. It's kind of interesting. I do this slide in our retirement seminars all the time. So if you looked at the S&P 500, for example, over the last 20 years, from 2000 to 2019, it averaged, I think it was 5.6%. So again, we look at the returns when you're in accumulation. Your 100,000 grew to like $220,000 in those 19 years. Now, if you flip the returns over and you get them in the reverse order, again, in accumulation, you still average 5.6%. You still have $220,000. And then I use the example. I say, what if I gave you $100,000, you put it in a coffee can and you buried it in the backyard, and I let you dig it up once a year and pull out $5,000? How long would the money last? It would last 20 years, right? And I said, what if I told you the coffee can outperformed the S&P 500 over the last 20 years? And everybody's like, no way. We set all these records in the market. You're out of your mind, Dan. You're crazy. Well, you look at the numbers. Again, we hit the dot-com bubble in 2000, 2001, 2002. In 3 years, you're down to about $50,000. Okay. Then the market recovered for 4 years, and then you hit 08. You lose 38%. You're down to about $29,000. Guess what? You run out of money in 2017. You only get $85,000 back on the 100 because you're making withdrawals of $5,000 a year, and you hit the bad returns early. It's crazy because this is the little mutual fund lie. The little lie the mutual fund companies don't tell you. Hey, we averaged 5.6. Well, if I'm pulling out 5% a year, how do I run out of money? Because you got the bad returns early. Now, you take those returns from 2000 to 2019 and just flip them over, and you get the good returns early and the bad returns late. Now you put in 100, you pull out 100, you still got 110 left. So when you're in retirement, the sequence of the returns is absolutely essential. You can't afford to get the bad returns early.
Thank you.
Dan, what impact does tax rates have on any kind of income withdrawal strategy? And what are some ways that investors maybe can minimize that tax burden?
Yeah, it's, I tell people all the time, taxes are on sale today. We're never going to see as low a tax rates as we are seeing today. After the Trump tax cuts in 2019, I mean, we're never going to be this low again. And let's face it, the country's a little overdrawn on the checkbook these days, to the tune of about $31 trillion. So when I mean, we can't do that, but the U.S. government can. But when they're that far overdrawn, how do you balance the checkbook? You either cut spending. Who is really confident the government is ever going to cut spending? That's not going to happen. Or you increase revenue, which means tax rates have to go up. So one of the strategies that we're employing, and I've been talking about it for 5 years until I'm blue in the face, think about Roth conversions. Think about Roth conversions, because from the day you retire until the day you turn age 72, when you are required to take distributions out of your retirement account, you have more tax flexibility in that window than you're ever going to have in your life. So fill up the bucket. Look at the tax bracket that makes sense to you. I mean, a married couple filing jointly in the 12% bracket, when you add in their standard deductions and maybe they're over 65, they can go up to about $113,000 of income, and they're only going to pay 12%. So if they're living on 60 or 70 grand, they ought to absolutely be thinking about doing a $50,000 Roth conversion every year and paying the tax, paying the 12% on it, because that's the last tax dollar the U.S. government is ever going to see on that money. Now, for some people, I think 12's the sweetest spot, obviously, but some people have the higher incomes and they're going to be in the 22 and the 24. I mean, that takes you up to about $350,000 a year of income. So we encourage people all the time, depending upon their income and their tax situation, let's try to transfer or shift some of that taxable qualified plan money into Roth, because it's going to benefit you down the road when tax rates are increased.
How about the younger investor, somebody maybe in their 30s or 40s who are in the early end of that curve? Should they consider a Roth contribution to a plan, and what else can they do to maximize their accumulations, because they're so much younger now? They have time on their side.
Jim, you hit the nail on the head. I mean, I have 4 children, and I have all of them making contributions to Roth IRAs, because let's face the facts. When are you making the most money in your career? Are you making, when you're just starting out, you're in a very low bracket, you're not making a lot of money. I mean, you're making the max income you ever have as you get closer to retirement. So if you're a younger person, you absolutely ought to be, if you're contributing to your 401k or company sponsored retirement plan, if they do have a Roth option, again, you're already in a low tax bracket, you're not looking for the deduction. You ought to absolutely be putting as many dollars as you can into that Roth option, because down the road, you're going to be thanking yourself, because all the money coming out the back end is going to be tax free.
Yeah. Have you heard any discussion about the government taking away the benefits of Roth IRAs?
Well, when they came out in 1997, I was pushing Roths right and left, and I was getting that kind of pushback. Well, Dan, it looks great, but I'll put money in it, and then the government will change the tax laws, and I'll get screwed. The government is so short-sighted when it comes to this. And normally when they change these things, you guys are both well aware of this, they grandfather things in. So if you put it in, I mean, let's say they change and say Roths are no longer available after 2024 or something like that. Okay, but the money you've contributed to then, they can't do anything about that. It was legal when they did it, okay? So they usually grandfather these things and say, from here on forward, just like the Secure Act with the Stretch IRA. Hey, if you died after 2020, you no longer get a lifetime stretch, you get a 10-year, okay? But if you died before that, you're good. So I think they're going to do, if they ever did change it, the money you have in the Roth is going to be safe.
Right. Yeah, I think.
I got one question. I think we have time for one more. What's the most rewarding part of doing what you do for people approaching or in retirement?
I'll tell you, we've had so many people, they buy us gifts and stuff. When we set up that income plan for them, and we tell them how to take Social Security the right way, and we tell them when to start drawing down on their retirement accounts, they sleep at night, they don't worry anymore. And it's just, it's so rewarding. They come in and they said, Dan, you're the best thing that ever happened to us. I mean, we were all over the place. We dartboard approach. We had some at Vanguard, some at Fidelity, some at Ameriprise, and you consolidated things. We know what our income is. We know what our tax bracket is. It's just a good feeling being able to help people, and they appreciate it as well.
Yeah. Hey, Dan, we've run out of time, but that's a really good way to wrap up, and appreciate all the work that you're doing in the industry and for your clients. And thank you for being part of the show. Stay tuned for our next show, which is going to feature Carlos Tellez of Steel Jupiter. He's going to tell us the magic behind the respirators and air filtration systems and masks that they develop and have helped us in the recent past that I think we can all relate to. In the meantime, thanks for listening, and see you next time.